All right, and welcome to another Tuesday with Sun Garden Investors Club. Uh, some of the folks who have joined us recently, if you're not sure, I'm Rob, um, and I am flying solo today. Dan is not able to moderate today, but it's okay. So just going to watch to make sure people can get in. So first, little good housekeeping. Um, I wanted to thank everybody who took the time to give some feedback to us for what we put out last week in terms of adjusting the threes report. I'm going to take you through most of today's, which I like to do on this call. It'll come out next few hours, but I'll hit some of the key points. We got some great feedback. Um, yeah, I always tell it to you straight, and I don't mind telling you that um, like all of us, I have choices about what I'm going to do with my time, and with all the writing work that gets thrown at me, which I really enjoy, bar chart and seeking alpha. Um, I'd always rather be spending more time doing this, working with people, let's call it directly but indirectly, non-personalized, and just bringing this huge case that I built over 30 some odd years of being a professional investor to people that are kind of sick and tired of, the usual BS. And so the feedback last week was awesome. And you can still go back if you like, and read that post. But there's going to be a lot of other posts coming up because those of you who've been with us for a while, I've probably been talking for about a year about, I wrote two books, 2006, 2010. It's been a long time, written thousands of articles, managed a lot of money, and now kind of retired, semi-retired. And I thought, okay, I got to take this, all of this information from all those years ago, and or I guess all of the last few decades, and I have to figure out a way to just communicate it in ways that people can understand and that people will get. Frankly, my concern is not, nor has it ever been, are people going to like this? Because even back in the days when we ran an investment advisory firm, we had a tight client base. It was a few dozen families, all with seven, occasionally eight-figure net worths, next generation. Now, it was like a club, except I was the fiduciary and I was also making the investment decisions. So we've always thought, wow, it would be great to create that same sort of broad feeling that, hey, we all kind of think not the same, but we think similarly, and then we also kind of gang up, if you will, on a lot of the crap that's out there and the hype and all that. So uh, but how do you capture all this? And so I guess the bottom line is, as you'll see in the coming weeks, I don't think it's going to be so much an ebook as it is going to be a build your own portfolio kit. Uh, but walking you through very, very carefully, starting with just refreshing memories or teaching people for the first time about what it is I'm trying to do with my money. And then you saying, oh, I like that, I don't like that. Yeah, that's pretty good. And maybe later, okay. And you'll figure out how to personalize it for yourself. And the way we deliver it initially will probably be a few posts or a little package of articles, tools, maybe even a spreadsheet or two. But I'm making a lot of progress on hopefully converting it into literally, uh, for lack of a better expression, a piece of fintech where you feed it information and it will help direct you and basically be a virtual version of what I did back when I was an advisor, except you're in charge and I'm just helping you kind of narrow the playing field. So, very excited about that. So I'm going to go through the threes report now. Obviously, if you have any questions, just pop them in the chat or open up your microphone once I'm done presenting this. And I'm also going to give you a little bit of a preview. I'm speaking at the Money Show this Friday for the, I don't know, umpteenth time. Those are good events. I've got a slide set that I put together for that, although frankly, it's about simplifying investing. And I don't just mean, generally speaking, simplifying investing. I mean, like I've said here for the longest time, we may get to the point one day where I say, I'm not sure you need more than a couple of ETFs, but not to set it and forget it, but instead for, I guess, what I would call proactive management. Uh, but the markets move so much in sync these days over lengthier time frames. Uh, think about it if you own technology or didn't own technology in the last few years. Big difference. So there are places, an increasingly shrinking number of places, where there really is alpha to be added, excess return above what you can get just by showing up. And that's what I'm focusing on, as opposed to, here's 50 stocks I like. So uh, with that, that's kind of an update, if you will, from the CIO's desk. Now let's go into this, which right now is a draft, but it'll be out in a few hours. Managing a manipulated market. I mean, look, the machines are controlling it. And I don't mean the AI machines. Maybe that's next. Although there's a lot of AI investing going on right now, or AI-driven investing, and certainly a ton of investing in AI. My bottom line on that is, I'm open to any possibility, but boy, this really smells to me like we're going to look back a few years later and say, how did anybody pay up for the future promise of something that might happen? It will definitely change our lives in certain ways. It also might get a lot of people, out of work. So it's, to me, it's almost impossible to not overestimate what the impact will be on the back end, the way they're going about it, with big companies kind of doing hand washing of each other's deals and things like that. I think there's too much excitement, but that doesn't mean that I'm not front and center trying to make as much money as I can. But defense is always first, and that's the big difference. Look, the raw score is still at 20. I'm going to actually skip down to that part because I want to highlight this here. So, look, raw score at 20 for nearly 3 months, just fine if you're a type of investor that says, I don't really want to do too much. I'll just, I got a few ideas, I'll let it sit, etc. If you're more of a buy and hold type, terrific. There's plenty of room for you in this club. But that if that's the case, I mean, you literally are not doing badly in the last few months. having 20% of your money in the S&P 500 or some other equity growth ETF or a collection of stocks, whatever your offense is. Having 20% in that, having 80% in T-bills, but you're still making over 4%. I mean, you would have made about 1% just from the time that Roar dropped to 20. So if you're not the type that wants to keep a constant eye on the markets, fine. But if you're like me, every day, every week is an opportunity to make money. I put out the Roar score and the threes report on Tuesdays every week, but in between there's a lot of stuff going on. So at least for me, but look, you may have a flat Roar score, but it doesn't impact the ability to be an active investor. It's just a little bit different, more trading, things like that. Okay. So again, while I'm still at 20, I still think this is a very high risk environment for the reward you're likely to get in a lot of places. Okay. Again, for those of you who are newer, because we definitely have some newer folks, thank you, is if we always have a chance to make money, anything, anytime, any reason it can go up. But how much risk of major loss is attached to it? And what I'm saying now is, if it said to me, hey, is this a good time to try to make money? It's always a good time to try to make money. Is there much risk attached in doing it historically? Yeah, it's outside the screen to me. Okay. That doesn't mean that you just sit in cash and twiddle your thumbs. I mean, for some people, that's a solution, and more power to them. For me, you can be proactive about this, and that's where some of the option work. Okay. You can be extraordinarily aggressive and extraordinarily conservative at the same time. As simple as, and this is the type of thing I'm kind of gravitating toward a lot of my stuff, is in an environment like this, yeah, I could keep it as simple as SPY and Bill. And right now, according to Roar, if I'm a conservative type, more moderate risk investor, would have a little higher equity exposure. But if I'm 20% equities and 80% in T-bills, well, it doesn't have to be the end of it. I can buy call options on the SPY, and I can buy put options on the SPY, or I can collar the SPY, and all of a sudden 20% doesn't act like 20% anymore. In fact, I can probably even own a lot more equity, maybe up to 60%, okay, kind of a moderate risk approach. But that 60% is hedged. It could be collared, it could be individual options. And again, not going to take too much time here to go into the details about the options, but that's just one example of how there's more than what meets the eye when it comes to what a Roar score of 20 or 50 or 75 or whatever it is. Okay. All right, this is me talking about what I was going to be doing. Let's see here. I did want to also update you on this. And there is an enhancement coming. Which of my personal portfolios are available on a daily basis? Those of you been with us for just a little bit have probably clicked on where you can go into that Snowball Analytics site and you can see one of my portfolios. But that site doesn't include options, and it has occurred to me that I'm better off, and this is what I wrote about to everybody last week. Got great feedback, so we're going to go ahead with it. But I'll just read this. Since I think the best value we can provide to paying audience is not what are you buying and selling, because you have to ask how much, et cetera. I mean, there's so many different things. It's just copying off of somebody's sheet. It might be effective for some people, but you take the risk that I'm not thinking the same way you are. We're not running this as a committee where everybody makes the same trades. Uh, so, uh, but instead, I mean, I'm trying to deliver more like a running commentary. But rather than just say, I like this, I like that, and I'm a chartist, of course. So it's like, I like that chart setup. I feel really good about this one. I'm not, I'm not sure about that one. I'm not sure how much longer I'm going to hold on to that one. Well, why don't I just show you a portfolio with lots of small positions in it, $1,000, $2,000, $4,000 per position, and uh, instead of me trying to come up with all kinds of mechanical ways to distribute that, you just see what I put into this sort of splash account of positions. And by the next morning, you can always look at it and say, oh, okay, if Rob has this in this trading account, it probably means that he likes the chart. If he just sold something, or if he's taken a small position, probably doesn't like it as much. And I'll just put some rules to it, and then you can just follow along. So it'll be a few things at once. It'll be live money that I'm trading, and look, it might be active, but again, the idea is every day is kind of like a snapshot. There may be days I don't do anything, and there may be other days where there's a lot in there, but it's an idea generator, is really what it is, not a model portfolio. If it does extraordinarily well, great. Maybe we'll all start a hedge fund. But really, it's much more about just giving you a stream of sort of stimuli in terms of buying and selling behavior that I'm doing with actual money, so I'm not faking it, uh, and allowing you to take questions off of that, notice patterns. Hey, I saw you bought 5 things today in small size. Oh, yeah, look at this. Yeah, the charts all look the same. Is that my imagination, Rob? No, it's not. I look for the same thing over and over and over again. So this is what I'm hoping to achieve with that. And so read about that in the threes report. Okay, other stuff on the threes. Let's see. Let's see. Okay, I do make a point here about do not get suckered. I'm not saying that uh, there won't be more moves like this one. Okay, I mean, cat's been running up okay, but the issue I have is days like today. We have them pretty frequently, and you will all of a sudden see the consumer staples sector without a lot of growth, and some companies may not be as stable from a dividend standpoint and all that. Well, it's bouncing, it's coming back up, it's starting to show at least some type of signal. Okay, this PPO is below zero, so it's what I would call optimistic, but it's not there yet. It would be much more meaningful if it were crossing up here, like you saw here. So I'm looking at this and saying, okay, I'm very skeptical these days where uh, big tech pulls back. All of a sudden, everybody's rethinking the AI trade and saying, everybody, and thank you, Don. I just realized you're not seeing the screen. There we go. You should be seeing it now. Okay. I usually don't make that mistake, but I made it today. Okay, so uh, here, here's XLP, just sort of a standard example here. Okay. Oh, look at this. It's starting to rally. It's looking good on the chart. There's some optimism here. Um, but wow, we've seen this a million times. You can even see it in the chart. I mean, how many times like, okay, they're going to take up. No, no, they're going to take up. No, they're going to, oh, look at this rally, a few days at a time. So to me, that's how lower lows and lower highs get formed. And it doesn't mean that I'm not predicting anything here. I'm just saying, as I said in the threes report, I'm kind of taking that Missouri approach. Okay, show me more. Otherwise, it's just part of the mechanical, machine driven way that markets work right now. Knee jerk reaction, AI trade bad. Anything other than AI trade good. It's different prompts all the time. But yeah, this is something we're also. I mean, like I say here, who had this on their bingo card, right? They're gonna move up AI stocks and utilities, huh? Yeah, of course, they provide all the power. But again, we're making a bit of a leap of faith here because we still have issues with the power grid, and it just there's so much more to it. Remember, I'm just a technician, okay? But um, this smells like euphoria to me. Utilities are not supposed to move like this. Okay? Last time they moved like this catches my eye. They did this next. Just saying. So you'll see more of that. I do mention bonds also. Looks like maybe finally rates are going to make up their mind. Those of you who remember the movie, oh boy, I'm forgetting. It was a Bill Murray movie about summer camp. The song was "Are You Ready for the Summer?" I can't even remember the name of the movie. Okay, maybe somebody will get it. But um, I remember they had the camp director out in the middle of the lake, and then he comes in and he's trying to make decisions about something that's going to affect the whole camp. And finally, Bill Murray says to him, "Come on, Morty, make up your mind." Um, and uh, that's what I've been saying to the bond market. Just make up your mind. There's been a lot of waffling back and forth for a few months here. I think it's getting closer to making up its mind in terms of rates going down, bond prices going up. We're not there yet, but it's looking better for those. Well, if you have a bond ladder, which is probably the biggest part of my portfolio right now, a simple bond ladder. Um, if if rates go, thank you, meatballs, by the way. Okay, thank you. I was never going to get that for some reason. The movie was Meatballs, folks. Okay, see, we like to inject a little 20th century humor. Yes, Camp North Star. That's right. That's right. Um, what is it? We're North Star CIT, so pity us. The food is hideous, something like that. Anyway, we'll have to do a whole session where I just take my entire investment approach or some things happening in the markets and express them in terms of movies from like the 70s, 80s, and 90s. My editors at Bar Chart and Seeking Alpha really love it when well, and I'm just kidding. They like it up to a point. Okay? I got banned back at ETF.com. The editor said, no more Taylor Swift song references. I had two daughters who were in their teenage years at the time. I mean, so anyway, we have to be able to laugh at ourselves because these markets are very laughable. So back to bonds and finish that up. Rates lower, bond prices higher. If you own a bond ladder, especially if you're out 5 to 15, 20 years like I am in the ladder, you've locked in a certain amount of money coming back to you every year. That's how I set it up, like an alternative pension for myself, or a second social security payment. Every year you're going to have this much coming due, and you buy zero coupon bonds at a discount now. Okay, I set that up a while back. I've documented it here, but when rates go down, especially if they go way down, okay, if you get this type of move up in bond prices, this is Govy, which is an ETF that's basically a 1 to 30 year coupon treasury um, uh, ladder. If you get a really, really continued strong move here and you own a bunch of sleepy zero coupon or coupon bonds, those prices are going to go up. And now you've got a really nice decision. you can do nothing and you know you're going to be getting the money back when they mature every year, or you can take a profit on the bonds, a profit you probably weren't expecting so quickly, if at all. Rates are lower, so okay, find other ways to put the money to work. So I probably won't get to it today, but I'm finding another new way to do something that I would say it's very collar-like, but I'm already thinking ahead and saying, geez, if rates go down, bond prices go up, and my ladder portfolio increases in value at a surprisingly strong dollar amount, I'm already thinking ahead as to, if I'm so fortunate, what would I do to take that and make sure I don't give it back? Because the last thing you want to do is take a bond ladder or any other type of very conservative investment, and when it does surprisingly well, take it out of out of that, go over into
sunflower seeds.
oh, I'm sorry, Sean. Mic on?
Oh no, sorry. Nope.
That's okay. Yeah, the last thing you want to do is take money out of a conservative investment that is just appreciated and say, okay, I just had a windfall. Let me take the windfall and let me buy whatever overpriced stocks unhedged. Okay, risk management is also about knowing how to play with a lead, as they say in sports. Okay, it's not and to never fall behind by too much. Okay, so that is the threes report. Let me see. We had some chat here. I think a lot of us about the movie Meatballs. There we go. Okay, good. All right, no questions. So let me open it up now, see if there's any questions. If not, I'm going to pick out just a couple of slides from what I'm going to talk about at the Money Show and show that to you in just a moment.
I have a question, Rob.
Welcome, Craig. Yes.
Yes, I'm a newbie here. Just joined the other day.
Great.
I'm very intrigued. I'm sort of moderately sophisticated in options, not highly sophisticated, just moderately
Me
so.
too, by the way. I'm not. As you'll see, I'm not. I mean, I'm not joking, but I'm also serious about how you don't have to be.
But I'm very intrigued about collars, which you seem to be very much into.
Yeah.
You have a video on it. And I'm curious, obviously, like you have said previously, the objective here is to get as close to net zero premiums as you possibly can. That would be a very desirable outcome, or even maybe a positive net. And I know that's sometimes possible as well.
You have to sacrifice some upside, but it's again, it's a trade-off.
Yes. Yes,
ahead,
but I do like the idea of the collar in that you might be able to maximize profit at perhaps 15% and maybe minimize your losses to like 2 to 3 or 4%. And if you like the stock a lot, if the underlying goes down a lot further than your strike price, you are basically, if I understand it correctly, you're lowering your effective cost basis. So you've entered the stock basically at a much lower price point. I've noticed that in order to get closer to a net zero on the premium, as I've been studying different scenarios, it seemed that in many cases, if I move the buying of the put up 1 month expiration from the selling of the call, it's more likely that I can get closer to a net zero premium. And I'm just wondering, if you're taking your call out, let's say 5 or 6 months, and then your put is out 4 or 5 months, do you consider that to be is that a reasonable thing to do, or you're obviously not protected on the downside for 1 month after the expiration of your put before the call expires, but of course, you could, I suppose you could roll it again and pay a little bit more to get additional protection for 1 month. Do you have an opinion on that scenario?
Yes, in fact, I'm going to look it up. Okay, you guys can still see the screen right here. I was pulling a couple things. First of all, let's see. I have no idea why the Dan Ives thing came up. If you want to try to get an idea, now you guys can see this, right? Um, it it is a real statement about um, how investment markets, or I should say, how investors um, look at markets today and how they look at risk management, which is not very often. When a ETF like this has 3.6 million in it, okay, that's it. So there is actually, and I'll try to pull up the index as well. Let me see if I can find it here. I guess not. But Global X, okay, these are based um, on actual indexes. Okay, there's the two ETFs here, and what they do is one for the S&P, one for the Nasdaq, and their entire approach is to constantly strike a collar with 5% downside and 10% upside. Now, I haven't spent a whole lot of time with these, but I'm just talking concept here. Okay. So that's why I want to show you. And there are actually indexes that go back a long way. I think CBOE, let's see, CBOE. I probably should do a little bit more on this. Yes, it's zero cost puts for, okay, yeah, there's I'll do a little research on that for next time. But there are actual indexes on some of these option strategies. So start with the idea that, okay, geez, you can just follow what an index does, and you can constantly be refreshing 95 to 110. In other words, you can make 10% or you could lose 5%. I usually look for a lot more than 2 to 1 on collars. And the question is, how do you go about doing that? And the other thing I'm going to check here, because I might be able to cut some time for it. Okay. Let me see. Yeah. Let me see if it has it. Yeah, nope, not going to find it. Okay. So what you're describing is what they call a forward collar. And I talk about it a lot. And frankly, it's kind of my go-to. And let me use the existing collar here now. Let's see, where is that Rob's live? Let's see why we're going to consolidate this. Don't have it. Okay, I'll use this example. So, you know what? Too complex. Too much running around the screen there. Okay.
Do you work in Thinkorswim? Because that's where I am right now, and I was looking at MRVL, which is one of the AI and Google stocks. Kind of, it's a semiconductor.
Let's do that live example. Okay. MRDL.
Yeah, MRVL. And I was looking at the 20th of February.
MRDL.
VL, Marble.
Got it. Okay. Yeah.
And I was looking at like the 20th of February 26th for the selling the call option. And I was looking at, let's say, $95
Let's see.
as the strike. And I'm looking.
I'm sorry. Dates again. I'm gonna load this in.
The 20th of February, 26.
There you go.
Yeah, and if you look at, it looks like if you do a strike of 95, which my calculations indicate would be a return of 10.18%. It looks like the midpoint is about $9 for the premium, like a positive 9, about midpoint or thereabouts. I'm looking at.
Let's see, 95 and 95 to the upside, right? The covered call.
Yeah, selling a call at about $9 premium.
Yep, there you go, 890. Yep, and
Okay.
and your choice of strikes on the way down.
Yeah, for the prior month, which would be 16th of January, 26, 1 month before that on the put. So I'm buying a put for $85, which is only like 1.41% lower than the existing price, which is a very, very tiny loss.
Yep.
$85, and I see that the midpoint on that is about, I estimated about $9.33. And so the net 933 minus about 9 is about only 33 cents, which is a very small percentage, just like 0.38%. I have to pay for the premium here, the net loss on the premium. So,
Yep.
I mean, I don't know, that strikes me as a very favorable kind of position because I can only lose 1.41% plus the 0.338% for the net premium I have to pay, and I can make close to 10% after you've taken out the 0.33 premium that I had to pay. So there you get like a 5-to-1 ratio. You talk in terms of ratios, the return to loss, I guess. Looks like it's 5-to-1. The maximum loss is very, very, very small. And if it were to drop down to 65, I would be very happy because I like this stock and I would be able to basically lower my
It all starts with the chart, right? I mean, for me, it all starts with what you think about the stock, you know.
Yeah. Let's assume that I like this a lot, and I do.
Mhm.
I could, if I held it as it fell fairly far, then I would be lowering my effective cost basis, as I understand it. I mean, basically, I could sell it at the strike price, which is almost the asking price right now, and I get the difference basically, or I could just
So
sell the put option. Sell the put option, and if it's way in the money, I don't know, maybe the delta is close to 1 and I'm getting, for every
so
dollar it goes down, I get an extra dollar in my pocket.
let's summarize here because I'm sure like a lot of you, I am visual. Okay,
Sure.
so let's summarize. Okay, we're going out to uh, we're looking at call and we're
A
looking
call
at
for the 20th of February of 26
okay.
and a put of 116. Yes, this is all in the new year.
Okay. Now look, I assume it's a volatile stock, so uh,
Yeah, it seems like,
that makes this easier to do. You probably couldn't do this with you know, Procter and Gamble or something like that. Okay,
it looks like the implied volatility is up like around 65%.
there you go. That's what helps. That's why it's been so difficult to. That's why my S&P or SPY collar has become a SPY plus puts, because there's just not that much on the upside. But anyway, okay. So again, this was in the neighborhood of $9 received, right?
Yes,
And it was a strike price of 95.
yes.
Okay. And the stock is at
86.22 right now.
okay. Probably should we get more, if I think we're going to have more examples like this, I'll just create a on the fly calculator for it. So, okay, great.
And the put strike price was 85, and
Okay,
we had to pay about 933.
okay.
Negative
So
933.
in round numbers, pretty close.
Okay, yeah, you could actually call it net zero almost.
Yep. Okay. Yeah. So, I mean, look, the keys, all right, keys to creating a zero cost collar. Okay, that's really what you're aiming for, right?
Yes,
A
yes.
zero cost collar. Me too. So, all right. The first thing is a higher volatility stock. That's going to help because it makes those option prices kind of freaky. All right. And that gives you more room to maneuver.
Mm-hmm.
Okay. Secondly, okay, go forward. All right. Uh, call expiration. Let's call it 1 to 3 months beyond that of puts. Okay.
Yeah, here it's about 5 weeks.
Yep. And I would say the other thing is keep upside aspirations tame. Why do I say that? Because you're talking about a return here of about 10% on a volatile stock in 4 months or so. Okay.
Yeah, yeah.
Not bad, but you'd have to do it that way. I mean, look, uh, but this is why, and again, you're you're new to the group. Thank you, but folks have heard me say this a lot. I mean, let this thing go to 95 next week. Okay, you'll figure it out. You could not touch this at all right, and maybe you'll have some downside, but it still costs you a whole lot. And you can buy more. It's not it's not that much of a handicap. So what I have done quite often is where I will take, and here I'll just do something like this. As a matter of fact, yeah, what I will try to do is kind of relate this what I've done. All right, I do a lot with SPY and Q. Okay, well, whatever based on the Q is. Okay, where did the Qs close today? I will chart this also before we're done. Okay, so call it 600. All right, so it's at 600. And I might say, okay, I am going to go out to January, just like you did. I might go all the way out. I don't know what the exact date is. I'll just assume it's that. Okay. And ideally, so I've got a 3 month spread here. What can happen in these 3 months, or what can happen in this 1 month? Well, let's play this out. If the stock goes down, moot point, right? You're gonna end up with this as a low, and the more it goes down, this will go up in price. You could also just sell it at 85, but you also see a lot of this $9 go to zero. You get to keep this $9. Okay, if it really goes down. If the stock goes nowhere, that's fine, and you'll have a decision to make a month earlier. And if the stock goes flying, well, this won't be worth very much. But as I see it, you get that stock to 95, you're ahead $10. I've done this over and over and over, as again people know from watching me kind of do some live money examples. Is you can take this see the stock go to 95 and say, oh, okay, fine. I'm going to go and just like I move a stop order up, I'm going to notch this up to 90 or 92 or whatever, maybe even 95 because I know I'm going to pay a little bit for it. I would do that all day long. And then I would look back after several months' time and I would say, wow, this is a great way to just keep rolling it forward. In fact, I think I'm.
Oh, so then you're further protecting your downside, you're saying, by
Oh,
moving that
absolutely.
put up option up. Because I was wondering what happens like if in the first 2 or 3 weeks it goes up to like $98. It wouldn't necessarily be exercised, right? At above 95.
No, almost all expirations happen. I should say almost all exercises happen right there. And the reason is if you're the other side, you know, there's a
You have a
good.
debit of $9 on top of the 95, right?
Well, and you're also thinking, you know what? Okay, if somebody, so you sold a call, okay, so yeah, if somebody bought a call option, right? First, there's the cost of it, okay. Then there's the fact that if you still got 4 months left, it's like I don't know if I had a call now. Again, I'm a very conservative investor. This whole investing club is based on, okay, but um, in fact, let me see. Can I find? I thought maybe I had something. I had a recent example, but I don't think it's in here. See, this is highlighting, why as much as I want to, sort of open the spigots and try to teach, the best way to do a lot of this stuff is um, is kind of one example at a time. I welcome any suggestions, by the way, for I mean, maybe it's a matter of I just say, okay, I can't do it through snowball analytics, but I can say, all right, here's the collar, all right, and I could essentially say I'm going to put money in SPY, and I'm always going to have options around it, and I'm not going to sell that SPY. I'm going to buy 100 shares SPY, and I'm not going to sell it as long as the club is in existence because I don't have to sell it because I'm always the ability to move around with the options, right? So that's kind of the that to me might be a good teaching tool. We're always looking for those. Okay, so anyway, this is the kind of forward collar. I've yet to really run into trouble with one of these. Not that it can't happen, but I kind of feel like whatever issues you have are high class problems, as they say. Um, okay.
I mean,
So
to me, it strikes me as an extremely smart kind of strategy. Like you're reducing your losses significantly, your potential losses, and you are still allowing yourself a significant return.
that's correct. This is so. Thank you. It's an awesome example. Okay. I'll quote another movie. One of my favorites, Bull Durham. A way to announce your presence with authority and joining the group. So, um, but this is the key. You won't get good price. Like here, I'll look back to here. Okay. Um, when I first started this, I was like, oh, you know what? I don't know. I kind of see it, feels this. It's not cheating, but here. Okay. Now look, you could, of course, it's only going out a week. So let me see here. Yeah, let's go to that front month here on Marvel. Okay. This is what guides me. Okay. I'm looking for that upside, downside. So what I'm more likely to do, and I'll kind of do what you did here, but okay, oops, wrong leg. Okay. See, I would start getting interested maybe in here somewhere. Um, because again, not really doing it for the income. Yeah, you want to keep the costs low. Um, you can only and you're seeing it here. Okay, like to keep your costs close to zero, you can get upside. I mean, look, it's if you think like a bond investor, okay, 4%
Hmm.
in 4 months, right, and not that much downside. but obviously you're going to want to do a little bit more than that. Now, look at something like the old S&P 500, and right, much lower volatility. And what I normally do here, to be a good recap for folks, okay, the first thing I usually do is I look at the put and I say, okay, I'm going to strike the put just about at the money, maybe a little below. Okay, 660. Well, why? Why have it all the way up there? Because it's going to cost me something. So I'd rather I get to the point where I effectively say, okay, my cost is going to be my downside. You see this?
Mm-hmm.
3% cost, 3% downside roughly. However, I don't think the S&P is going to 825 in the next 3 months. Wouldn't put it past it. Then you'll know it's 1999 all over again. But let me see. So what I'll do is I will scan down here. Oh, look at this. Geez, that's 4 to 1. It's a lower cost. 7. I mean, so I kind of go back to, all right, where can it go? I don't want to bring up another screen here, but okay, so let's see. You know, if it always starts with where I think this is going to go, because the idea is not the to me it's never, oh great, I want to use a collar. No, it's I want to own a stock or an ETF, have lots of upside, not a lot of downside, and that includes I wake up one morning and something has happened and it's just blown me out, you know, and I feel as badly as if I had a stop order, which I think only stops progress. So something like this, okay? 760, yeah, let's just assume for now, all right? It can get to 760. So I'm going to click on this guy here. And I don't love this view, but basically, and of course, again, look, I'm bringing in almost nothing. You see this? It's costing me this. This is the exact, I don't even need this. This is the exact issue I'm talking about right here. Okay. Sure, I'll pay what amounts to 3% to do this at the money. That's my downside, 3%, because I can sell it at 660. It's trading at 662, so it's right there. So my worst case scenario over 3 months here is 3%. Well, I can get 12% upside all the way up to here, but I could also get unlimited upside. You know, if I just don't pay if I just don't take in the 43 cents premium. Okay. So I hope everybody gets that. If not, please ask. But that's what happens when you have low volatility, okay, in something like the S&P 500. If I ran this on, I'm trying to remember. I'll just do the one I know. Okay. It's one reason I kind of like doing collars on levered ETFs. It sounds like it's like walking into the casino, but I think it's just the opposite. You're using the the high octane of 3 times ETF, and I've done this before, showed people in the group, but um, but again, if this really breaks, so what? The whole idea of a collar, the whole idea of Rob Isbit Sun Garden investing always is how can I try to take risk out of taking risk, because I'm always trying to make money. But when the market environment is anything but pristine, and I remember when it was, I have to manage risk, and these are all just different ways to sort of exercise that risk management muscle. So I'm going to do the same thing here. I might have to give this a little more room, okay? But let's see what happens here. Okay. My guess is I'm not going to get what I want without going a little further out. So let me go to March, and getting closer, but I'm probably going to knock this down. Okay. You really have to kind of rehearse this over and over and over. Um, okay. And so, but this is why a lot of times I'll end up with that forward collar. Okay. So here, I'm going to go back to.
Rob, a question. I'm not familiar with Bird Chart Premier. Is this a really good tool for comparing strategies?
Look, to me, its beauty is in its combination of simplicity, uh, but like 20 years of research, I should say, of data engine. Bar chart premium to me for the money, along with seeking alpha premium, best two things going. And it's not just because I write for them. It's I write for them in part because I am already a fan of the tools, and it just makes it easier to write. So
Good.
yeah, huge fan of this. We even, as a matter of fact, in both cases, we have like an affiliate discount. So if anybody's thinking about getting a subscription to either, and a lot of you came from Seeking Alpha, but yeah, we have a discount. I don't know what it is, but I know it's not modest, and it's a pretty good discount because we're associated with them. Anyway, so to finish up this example, and we'll see if there's any other questions, but hey, if I drop down to, I don't know, maybe 95 here, I get all the way up to 125, which is kind of nothing for a 3-time ETF. That's like 8% NASDAQ rally. I'm getting there, but then I'm going to end up with the same type of thing that you did, Craig, where I'm probably going to have to go out 3 months further out with the call option in order to try to get anything closer to $10.60 that I'm paying for this one. So, look, I'm always looking for a better option calculator. Um, what I found in Thinkorswim and some of the others is that they're great, and this is just personal preference. They are great if you want to try to basically be like a pseudo programmer's mind to go and say, oh, give me this and that and whatever. I'm very, as I like to say, kind of meat and potatoes. I will still do this constantly. Maybe one day we'll have something where I literally just say, okay, I'm going to go to work. You guys can watch me if you want. And then ask questions. Okay, so I will just do something like this with the charts. Oh, okay, Walmart, yeah, news related, big deal, et cetera, with OpenAI. Okay, and I'll just start zipping through these charts, and it's like, this is good enough for me. Oh, that's interesting. Remember what I said before about the staples. Okay, maybe there's something going on there that's a little bit extended, but it's still moving. And I can just look at this and I can size everyone up, and probably and this is what I do. This is what I'll be doing after this call, going and just running through the charts and kind of filling out the rest of what's currently in here that's going to go somewhere else. Anyway, that was a great lead into a really good discussion. So let me see. Benny has a good follow-up question. No particular trade, just looking for guidelines. Say 5% of stock price is okay, but 10% is too expensive. I want to make sure I know what we are answering. However, as somebody had said before, you've seen some of my collar work. Here's some good news. It's kind of a side piece to all the other educational portfolio construction materials, because it's hard to mix options with ETFs and in portfolio construction. But I'm just about done with a collar ebook guide as well, and that will include things like what's a standard setup or where do I start. But to me, I do not want to lose more than 5% on anything if I can help it. 10% worst case. And I mean something with a normal position size. When I'm trading something in small size, I don't care. I mean, I could lose half of it, you know, if something bad happens, because I haven't put up that much money. This is all what I'm kind of filling this investor kit with. I wanted to show you just before we finish up here. Here we go. Okay. Because your question led me right into it, and this will cover a lot of ground, not take too much time, and we'll close up after this if unless there are other questions. So you're going to see a lot of this type of stuff. We'll put some of that at the Money Show, but I've been talking to some folks who are, I would say they're probably a little less experienced investors, but very hungry to learn. And between them and this awesome group, I am thinking much more about, okay, how do I make this so not so much simple, but elemental so that you can kind of build up to it. And again, you'll see this in everything that I'm finishing creating, but I'm basically building something called an ETF portfolio builder. All right. Now, you already have this, but I think a lot of people maybe get deterred when they go to here and they say, wow, that's a lot of information, a lot of ticker symbols, and oh my God, there's too many steps. Okay. You know, I'm trying to take the same information and deliver it in a little different package. But at the end of the day, creating a portfolio using ETFs is as simple as, okay, which of these tiers do you want to use? Do you want to just go SPY build to start and get used to it? And then once a week you see the Roar score and you change it? Or do you want to go a little bit beyond and have 5 different possibilities for offense and 5 for defense? Or, and do you want to own only one of these at a time, or do you want to own more? I'm going to try to take every step of the process and just lay it out so you can fill it out like a survey. And Lord willing, maybe we'll even have somebody that knows something about how to program this stuff, and we'll have something that you kind of use yourself to make your own decisions, but making sure you've accounted for this. Okay. So, for instance, the first decision that somebody has to make is, what's my downside risk? And I mean, like in the whole portfolio. Separately, you ask it the individual position size, but this is more important. Well, by the way, this is me. Okay. I'm a 5%er. All right. And that's why I use options, and that's why, you know, Roar at 20 means 20 for me, not the other version of it where, you know, you have to have at least 50%, the moderate version we call it. You know, you're always at least 50% equity, and you're deciding based on Roar what the other half of the score is. I should say, yeah. So you know, right now Roar's at 20. Well, it's 50 plus 20% of the other 50 is 50 plus 10 is 60. So the effective Roar score, if you're a conservative investor, you're at 20% equity. If you're a moderate, you're at 60. So anyway, this is your target downside risk. And if it's more than 20, you're probably in the wrong room. Maybe we can figure out where you should be, because this is about risk management. Okay, how many offense and defense ETFs are going to use? Well, you could start with the one, the SPY and the Bill or whatever. And then you say, okay, I'm going to consider 5. I'm going to consider 10. Okay. And, you know, are you going to consider those, you know, subsectors and sectors, which are like, bring it up to maybe 50 ETFs in total? How often are you going to evaluate what you're doing? Weekly? Well, that's easy. Could be every 2 weeks, could be monthly or quarterly. You know, maybe it's going to be every day. I mean, for an ETF portfolio, it may not be every single day, but this is what we're putting together. And then the same thing with building a collar. Well, which ETF are you going to use, or is it going to be a stock? Okay. you're going to collar it, or like the example I just showed you, a lot of times now I'm buying puts, because why should I write a covered call and get paid almost nothing for it? You buy calls. I don't even have just buy covered calls with your stock or ETF here, because I almost never do that. That's for the Jeppy fans and all that stuff. To me, you're just leaving yourself open for all the downside or most of the downside, and I just don't get it. Anyway, okay. Is a T-bill ETF part of the position? Okay, because you might look at it and say, geez, I could take a lot of money, put it in SPY or Qs or whatever. I can keep a collar around it at all times, and I probably don't even need much money in cash, even when I think the market stinks, because I'm letting the collar do all the work. Okay, so these are the types of things that I am trying to build in for you guys. I put this here. I mean, you can gaze at it right now, but effectively, this is what I'm showing you. Okay, I did more work on this today to clean it up a bit, but I'm trying to walk you through a whole step by step process here that can be repeated over and over and over again. And ultimately, once you understand yourself as an investor, now you're ready more than ever to start using the research, if you will. Okay, which tier you're going to use, how many slots you're going to hold, how many securities, how many positions, okay, how many weightings, all right. And there is also something, and I'm going to leave myself a little mnemonic device here, because this is the live sheet. 1, 2, 3. Okay. 7, where are we? I'll figure out how many I'm going to put in here, but it will probably be something like a 7x7 box. What's going to go into the 7x7 box? I'm basically going to create for you. This is position 1, position 2, 3, 4, 5, 6, 7. Okay, this is just a cookie cutter version of how I used to run my old core portfolio, which was how I managed almost all my clients' money. I just wasn't this regimented. And all I'm doing here is saying, oops, okay, every one of these is going to be an ETF. I'm showing this to you so I can get some feedback, say, hey, I didn't get it, what you were talking about, or whatever. We always work faster toward building these things when we know there's people waiting for it, So, okay, this would basically be your position, okay? So that's, what do I mean by position? If you look at your statement, okay, and you sort it by size, well, that might be your biggest position. Okay, well, maybe that's all right. I'm always going to have, I don't know, whatever, 30%, 40%, 50% in some SPY or Dow or Qs or top 20 stocks, whatever. Okay, and then I call that like a core position. Then I'm gonna have a couple of support positions, and then I'm gonna have a couple of high flyers. Okay, this might be my, hey, I think oil services looks good. All right, I'll put 5% in that. Or maybe I'll even have something that's like a triple levered or whatever, and say, okay, I'm going to make that a 2% position. Okay, maybe I'm going to have a levered VIX ETF, which can go up hundreds of percent at a time, but I'm going to keep that position really small. Okay, this is no different than saying we're playing a sport with 7 guys on the team. Okay, and out of those people, we need one for each of the 7 positions on the field at all times. Okay. All right. So that's a bit about where things are going and the shortcut and all that. Let me know if you. Oh, I have one more question from Jason, and then we'll finish up. Will you change SPY bill to something else? Is if the yield on bill drops below a certain amount? Great question. I would if I also thought it was a good defensive measure. Okay. And let me just highlight this for you just using this. Okay. I'm more and more convinced that you can get a lot done with just a couple of ETFs and rotation because I'm a chartist and I'm monitoring through the Roar score. The Roar score helps with all that. Part of the reason that SPY is this low, it's not about. Let me answer the question a couple of different ways. Okay, so what if I had to stick to SPY and bill? Well, if T-bills go to 1%, I'm not getting as much for my defense. So there's two ways I can adjust. One way would be that I'm just always going to have a little bit more in SPY than I might otherwise because the defense is still good in terms of not losing, but it's terrible in terms of making. Okay? Because I'm only making 1% annualized versus 4 or 5. The other thing I could do is I could increase the velocity. Okay? Not the volatility, but the velocity. Meaning I'm just going to really okay, the Roar's at 20. Maybe I wouldn't have been so patient keeping it at 20 for all those weeks when the market started to go up. And now all of a sudden, I have to do a little bit more trading at times, higher turnover in order to do it. See, these are all just different parts of the same puzzle, okay, or machine, if you will. Now, would I go ahead and change? I mean, for years, many years, okay, when I was running a portfolio where I would call it, I could buy any ETF, and I did do a little options work in that old core portfolio. But I thought that, I almost never used cash. What did I do instead? I would do something like this. I would say, okay, my offense is going to be whatever I think is going to, do well for a while from whatever set of these I'm using. All right, let's take the most robust one. So I might look at it today and say, okay, it's still, top 20, top 50, whatever. Yeah, Bitcoin is inconsistent, but have a little bit in there. Not much for dividend. Oh, Japan was good for a while. So emerging markets, small cap, whatever. I will develop a little mini offensive basket here that is 2 or 3 of these. Okay. And then on this side, well, anything that's fixed income oriented is going to stink. Okay. And so unless I think that I can get a decent defensive return, well, then I start branching out and say, maybe gold or a foreign currency would be one way to play defense. Or really one of my favorites, because I was forced to do it basically for better part of 15 years, okay, when rates were at zero, is I might say, you know what? It could be as simple as, hey, I feel like the Dow stocks are rallying here. I don't feel that way, but I feel like the Dow stocks are rallying here, but I think that small caps are really gonna be rough sledding. Well, then I'm gonna put, I don't know, 60% in Dow, and I'm going to put 40% in RWM. What's RWM? It goes the opposite of the small cap. So I'm doing a little 2 ETF arbitrage here, where my performance will be based on how much the Dow outperforms small caps by. And if Dow does well and goes up and small caps go down, that's a win-win. If they both go up or they both go down and the Dow outperforms, I'm making money. This might be either totally confusing some of you, or it might be blowing at least one of your minds, because nobody ever teaches us how to think this way. But to me, it's just, it's sitting there right in front of you. If I like this better than this, well, and yes, I'm giving up a lot of upside potential. Why not just buy the Dow and put the rest in cash? I could, but I'd rather buy more Dow because I look at the charts and I say, wow, Dow looks great and this looks terrible. It doesn't matter what they are. It's any two things. It could be two sectors. It could be a sector in industry. I'm looking at all kinds of possibilities. I'm even looking at, and I will show you this, then we'll close up unless I see another question. I've been building more lists for myself and for you guys. Here are all of the single inverse ETFs on stocks that I could find. There's a lot of Tesla, there's Nvidia, etc. You know what this means to me? I could teach anybody who wanted to how to run a portfolio that plays offense by buying stocks, just like people have been doing for, well over 150 years. But the other part of the portfolio is to find, if it's not sectors, industries, okay, because I have some of these too, see? Inverse sector industry theme. There's so much inverse now. And look, I mean, it's not for the faint of heart, okay? But if you figure out in advance what your what your worst case scenario is, I mean, yeah. Look, if you think the financials look terrible and the banks don't look very good to me right now, all right, well, maybe a little bit of ultra short financial and some T-bill and some whatever, S&P or NASDAQ, okay? But it all comes back down to scanning the market, reviewing the charts for me, and setting that bottom line roar score, okay? And the bottom line here is, if the roar is at 20, I can get to 20 in an infinite number of ways beyond SPY and bill. So I am very glad that you asked that, and I hope that I answered it, to your satisfaction. Okay. All right. Looks like I did. Yeah, BDC or preferred, Benny asks. And yeah, I mean, look, that's the, what do they say? Yeah, we're about to start cooking with gas here, at Sun Garden Investors Club, because I sort of slapped this together using some of my favorites, but the key here is not for me to put this out here and for you to, sort of gaze at it and say, oh, okay, oh yeah, I forgot that was there. Because I mean, if it were me, I might say that, and it's my work. But what if I said, hey, I can show you how I complete this whole thing. I can show you how I use it, etc. Okay. And now that you're in the club, why don't you, we'll have you come in, okay? And we can have people as volunteers if you like, and just say, okay, good. Ready? Let's talk about it, okay? Or let's build it all together. We do it as an investment committee. Probably take us 3 hours one day, but we'll make it a seminar, okay? To me, this is what is so empowering about do-it-yourself investing. You know what is not empowering about do-it-yourself investing? What stock should I buy now? Hey, what do you think the Fed's going to do? That's the other guys. And I'm here to teach you how to be your own portfolio manager to the extent that you want. If it's SPY bill or if it's another tier down. And it starts with being able to think about all the important questions that I've been asking myself and anybody that I was working with or for 30 something, almost 40 years. And I want to impart that to the folks that join the club or the Substack and work with us. All right. Any questions before we close up for today? Those are some awesome questions.